Go ahead, Leia. Uh-oh, she frozen. Ah.
Hello, all you startup investors out there. Welcome back to this week's Kingscrowd Investment Roundtable. As always, we have some fantastic topics planned for you. We're going to be talking about this week's Kingscrowd Chart of the Week, where we look at zombie companies and annual revenue growth. Very timely in terms of the Halloween holiday coming up this week. Also, in addition to that, we're going to be talking about some of the different new features and on the Kingscrowd raise pages. We'll be briefly giving you an update in terms of how some of my and the Crowdfunding Professional Association's meetings with the SEC and different groups in Washington, D.C. went last week. And lastly, we'll be diving into this week's deal review, which will be Trevi Systems. Before we jump in, given that this week is the holiday, just curious, Teddy, Leia, what's the best Halloween-themed costume around startup investing that you've ever seen or heard other people is dressing up as? I've heard, a lot of times I think the venture capitalist with the Patagonia vest and sweater type thing. I think that's a pretty popular one I've heard of. But what else have you seen out there?
I've heard of some people dressing up as, like, instead of a DEA agent, it's like an SEC agent. I think, Brian, you actually told me about this earlier, but that is phenomenal. But I will probably do what I do every year, which is just wear all the Taylor Swift merchandise I own and just kind of go out there and wear all my bracelets. And, it's a timeless.
Yourself. Yep. Teddy is our resident Swiftie here. And for those who haven't been aware yet, I'm sure that'll be coming up in the future.
Yep.
What about you, Leia?
Well, the best costume I can think of is dressing like a king to represent Kingscrowd.
Ooh, that is a good one. Awesome. Well, we hope everyone has a great Halloween week. But before we dive into the chart of the week around zombie companies this week and what those are, quick update on some topics from a couple weeks ago. So I had mentioned that I was actually going to be in Washington, D.C. last week, which we were. And I was there as part of the Crowdfunding Professional Association, where we had 3 or 4 meetings with different groups and advocacy groups with the SEC, as well as we met with a couple of different committees on the Hill. So we met with the House Ways and Means Committee, Senate Finance Banking, and House Financial Services. So what we were doing, we're bringing some of the feedback that we hear from all of you and that the Crowdfunding Professional Association has gotten from the industry and giving some of that feedback to the SEC. So if you go back a few weeks, remember we were talking about some of these issues where, for example, not all PDFs that are uploaded as part of Form Cs and EDGAR are searchable, which can be a huge, huge issue for investors and sounds like should be theoretically a pretty quick and easy win. In addition, we're talking about just some other updates around better disclosures in general, improvements around SPVs, potentially increasing further some of the Reg CF limits so they can raise up to $5 million every 12 months. The CFPA was actually advocating to increase that more to allow more access to capital for founders and entrepreneurs. And then also we were talking about a tax bill that the CFPA is proposing. So you can think of this for some of you who may invest in real estate. There's tax benefits, 1031 exchanges. Even if you're a homeowner, you get a tax benefit for writing off some of your mortgage interest, right? For example, and there's kind of first-time home buyer tax credits. Part of the reason for that, right, is that it incentivizes people to, own homes. And so there are other ways of potentially incentivizing, for example, investors in the startup investing ecosystem. Now, there are some existing tax incentives, tax advantages out there, but they're really more focused on angel investors. We can dive into those kind of some other time. That's like qualified small business stock, Section 1202 and some other areas. But what we were pitching was just super, super simple tax proposal. There would essentially be a tax credit up to $1,000 of 50% of any investments that you make in Reg CF. So if you make $2,000 in investments in a given year, you could get a $1,000 non-refundable tax credit. So very interesting just to see with all the dynamics of it being election season, but lots of good discussions there. I'm sure I'll be providing more updates as we get into that in the future. All right, with that little sidebar, let's jump into this week's chart of the week. So we were talking about and looking at zombie companies. Now, what is a zombie company? A zombie, right? If you kind of think of the undead sort of like limping along, they're dead, but they're not really dead. It's a term that is sometimes used in the venture and the startup investing industry that signifies a company that is still around. They're still alive. They haven't shut down. They haven't necessarily liquidated, but where the investor's capital is tied up. So that company isn't necessarily growing. They aren't necessarily having any exits or acquisition offers. And so investors' capital gets tied up. So what we wanted to look at is, as a proxy for companies that may be continuing to limp along, continuing to raise additional capital, but not really growing revenue, what does that look like in the Reg CF industry? So what we took a look at was annual revenue growth by year. So this is from 2021 through 2024, year to date. And this is basically the raises that started in that year. Now, remember, when a company files for a Form C for their Reg CF offering, they're typically including the prior year financials as the most recent. So companies that started in 2021 are probably representing their 2020 fiscal year revenues. Similar for 2022, it's 1 year behind. One of the trends that we saw when we took a look at the data is you can see that from 2021 through 2024, the orange bar here is the median annual revenue growth. So that means that companies, the median company, 50% of all companies, basically were growing at a rate of 24% year over year for increasing revenues in 2021. Now that went up in 2022 to 56% revenue growth. Again, you can think of what was happening around this time frame from 2020 to 2021. A lot of people coming into the market, a lot of companies were probably seeing very high growth rates, but then the Fed started tightening and raising interest rates. And what we see is kind of the after effects of that. Revenue growth started to take a dip where it actually went down to 46% in 2023, and it's actually been 12% so far in 2024. Now, these bars, you can think of them as kind of a box and whisker or stack bar chart. What that essentially means is the bottommost quadrant here is the bottom quartile of companies. So you can see the bottom quartile of companies it was down to basically 97%, negative 97%, up to just a little bit more than positive. Whereas the second quartile is, from that roughly 0 to maybe 50% growth for this year. The third quartile, so that's from around that 56% up to almost 200%, and then the top quartile of revenue growth being a lot wider here in 2022. Now, one of the observations you could make, right, is we take a look at this, companies are growing revenues a little bit less year over year. Personally, what I might take away from that is that companies are now focusing more on being profitable rather than a revenue at all costs kind of growth mindset. But, Teddy, Leah, what are some of your first impressions about this when you look at it and when you're looking at the companies that you're seeing in the market today?
When you're evaluating startups, like my frame is always, okay, I'd like to see at least 50% revenue growth, just like overall. And obviously, like you mentioned, Brian, with companies focusing more on profitability now, you don't necessarily see that as much. But just think about this graph, and what stood out to me is that, so this is repeat issuers. And generally, when I think of a company raising a new round, it's either because they're doing well and want to throw more fuel on the fire in terms of, putting more into marketing, hiring more people. So they want it to actually increase their burn because they're looking to grow, or it's because they are very low on money. This is probably more typical, is they're low on money and need to raise additional funding in order to survive. So it seems like the repeat issuers here, it seems to fall in that latter category, which is interesting. And maybe they don't need it to survive, but they're looking for some cushion to kind of give themselves some runway for the next 6 to 12 months, which is pretty typical for startups, I suppose. But that's what kind of stood out to me. It's like these repeat issuers are not growing revenue over 50%, when I would prefer to have seen that as they're raising money to put it more on growth. But it's changing times, like you mentioned, Brian. So it's complicated, I think.
What about you, Leah? Any takeaways from this chart for you?
Yes, before investing into a company, I always like to ask the founder what is their latest revenue. So if I'm investing early in the year, January to April, before they have to disclose their previous year financials, I'm always going to ask what were your revenues last year. So in a couple of months in January, I'm going to ask them what were your 2024 revenue, because a lot of time the revenue from the previous year that we see on SEC filings are simply outdated now. The company may have been growing its revenue quickly, may have been decreasing its revenue, if maybe stagnating its revenue. There's something that I need to know as an investor. And if I'm already somewhere between April and December, I'm going to say, well, what is your 2024 revenue to date? That helps me understand what are the progress that they are making. They could have a difficult year in 2023, which shows like some of these companies that we see on the chart, or they're trying to be profitable, that shows a revenue decline. But I want to know, what is their growth strategy? Are they increasing the revenue? Do they have any contracts that are coming in the next couple of months that is going to jumpstart the revenue growth? I know that we have at Kingscrowd the privilege to be able to talk to founders, but it's something that investors can also do in the discussion section. And they should definitely ask founders these questions to understand better what is the current position of the company.
Utilize the Q&A section, because you can get good information there, and you can also see if founders are not responding on there, like that's a negative sign. So Q&A is hugely valuable. So
that's a perfect segue actually to something else we wanted to talk about real quick before leaving this chart. So I guess one of the other takeaways for me, right, and while this is repeat issuers, the thing I think for investors to just be aware of when they're looking at companies today is that you're not going to see some of these 300, 400, 500% growth companies like you were seeing in 2021 and 2022. So investors need to perhaps temper their expectations a little more. And you are looking at more of a top 50% or even top quartile type company if you're in that 50% plus revenue growth, whereas that was, more middle of the road back then. So that'd be my last takeaway for this. But on the topic of finances, we should definitely take a look at some of the new features and improvements that we've recently made to the Kingscrowd raise pages. You'll see that things look a little bit different, but one of the things that we actually do highlight, as Leia was just pointing out, most recent revenues are very important. And one of the things that we ask the founders, especially if the revenues are a little bit more out of date, is what are their most recent financials? So what you can actually see here is in our new financials tab, we pull out some of these key metrics. So this is their revenue, as well as the year-over-year revenue growth, their monthly burn, the cash on hand, and the gross margin. But you'll see here, it says as of August 30th, 2024. So what we actually strive to do in most instances is get that actual latest revenue, latest monthly burn, latest cash on hand. So you're not depending on numbers that might be 9+ months out of date. Now, the interesting thing too, you can take a look and, do a deeper dive into some of the numbers with the detailed financials, but we pull all these stats out on each company to highlight them a little bit more. Now, Teddy, I know you put a lot of thought into, some of these different numbers in terms of the financials and how we show that. You look at a lot of things like gross margin. Do you want to talk a little bit just about why this is really important for investors to look in some of these key areas?
Yeah, for sure. I mean, for monthly burn and cash on hand, like this is probably the most important metric that an investor could look at. How long can the company survive on their current cash on hand, and how the current crowdfunding round, like how important is it to sustaining operations? So like some companies, they like are dire need of a capital infusion, so they are highly dependent on the crowdfunding round, whereas others might not be so much. And then on the gross margin, yeah, it's I think kind of in the next phase of this, we'll have the gross margin and whether it's gone up or down since the previous data point that we have for it. So that's really important to see, like, our margins expanding or contracting over time. For startups, at the beginning, they might have really bad margins, but because they're just kind of getting started, haven't figured out the manufacturing side, whatever it might be. But you definitely want to see that slowly, or hopefully fast, growing over time. So yeah, super important. This is something me and Brian have been working on for a while. There'll be some more updates on updated financials and how they're showed here. But this was a great first step. So thank you, Brian, for
awesome.
all that you've done.
No, thank you, Teddy. And yeah, just so you can see too, like how this cash on hand is the actual latest number as of August, because you can see the cash on hand, if you're going by fiscal year 23, would only look like they actually had 600K. So that's where we try and always get the latest numbers for Kingscrowd investors. And that way you can do correct calculations in terms of burn rate and all those types of things. Now, some other changes we made to this page, I'll just show down here first. So the company funding growth, we now showed the total prior capital raised, as well as whether a round is VC backed, as well as the prior online rounds. But then back at the top, if we look at the new tab for the company and the team, we're also showing the titles and the actual names of the founders, as well as if these founders have had prior exits and the total team size and direct links to their LinkedIn. Leia, I know that you talk to a lot of these founders doing founder profiles. Can you talk a little bit just about why the team is so important, and for example, why we might be showing things such as if a founder has prior exits?
The team is actually one of the most, if not the most important data point to look at when you invest in a company. If you think about the most successful accelerators in the world, they don't include founders in the accelerator because of the idea, but because of who they are. So when you invest in a company, especially when it's early stage, especially when it's pre-revenue, you're not betting that much on the idea in the market, you're betting on the founder, because the founder will be the person who will have the ability to pivot if the company realizes that there's no product market fit, for example. So when you're investing online, you often do not have the opportunity to talk directly with a founder. And that's okay. We have a lot of resources that are available online to help you understand if a founder can be successful. The first thing to look at is if a founder already had previous exits. And we are pretty lucky on equity crowdfunding platforms. I believe about 10% of the founders that are raising had previous exits in the past. So that shows you that there are a lot of high quality founders who already sold or put their company on the public market and who could potentially reiterate this success with the company that they are currently offering to you. You can also look at the LinkedIn profiles. We also like looking at whether founders have previous common experience. We know that a founders that have been working together in the past have a higher chance of success. They will have a better team dynamics. They have a lower chance of splitting that founders that did not previously work in the past together. So these are some of the things that you can look at when you look at a team from an online investing perspective.
Awesome. Well, thank you. I think these are going to be just huge benefits to be able to put more of that tangible, helpful info that investors need when they're considering deals in their hand. And in addition, just as a reminder too, if there's ever other funding rounds available for a company, you can see those funding rounds up here. So the ones in red are prior closed rounds, and the one in green means they have a current live open round, which is this one we're showing here in Start Engine. So great overview of some of the new features. I think we have a lot more coming in the next few weeks and months as well. So we will be sharing more of those as we release them. But let's pivot over and talk about the deal this week, which is Trevi Systems. Leia, you want to tell us a little bit about Trevi?
Yes. Today we're talking about Trevi Systems, and I'm very excited because this is a different type of desalination company. So those of you who have heard about desalination, you're probably thinking about this huge energy intensive desalination system that are desalinating the water from the ocean. And you probably know about all the problems that are brought with desalination. One of them, for example, is, as I just mentioned, they are extremely energy intensive. I think that in Saudi Arabia, the company burns about 1.5 million barrels of oil a day just for desalination. Another problem that comes with desalination is that it produces a brine that is a mix of minerals, including sodium or lithium and magnesium, which is basically what makes the salt. And it is often put back into the ocean, which is damaging the ecosystems. So desalination today is actually needed in many parts of the world. I mentioned the Middle East, but this is also the case for the United States. About 45% of the 48 lower states are in a drought or have been recently affected by a drought. So desalination is needed, but it brings a lot of problems. What Trevi System is doing is giving us a low energy desalination solution. So Trevi System is using a technology we call forward osmosis, which is different from the traditional desalination system that you use in the ocean called reverse osmosis. Forward osmosis is way less energy intensive. It is not able to desalinate the water from the ocean, but it can desalinate the brackish water that is available underground in many parts of the country. And so this is an opportunity, for example, for farmers who live inland, do not have enough access to water, to be able to access fresh water, even if the state, for example, like it is happening in California, is limiting the amount of fresh water that they can receive. But what is very exciting about Trevi System is that they have other opportunity than just doing water for farming. They can also clean the water from oil fields or mines. They have actually I think this contract is about to be signed, if it's not signed already, for a Tesla nickel mine. So they're going to be able to clean the water for this mine. Then the water can either be reused or disposed, but that will help the mine be compliant with water regulation. It's the same thing for oil fields. In oil fields, fracking a single oil or gas well can actually use as much as 40 million gallons of water. So these fields need to be compliant with water regulations as well. So why do we actually like Trevi System? Trevi was founded by John Webley, who has two previous exits. Like we just mentioned earlier in this video, this is a sign that this is a founder who can lead a company to success and make its investors successful. In the case of John, his two previous companies were exited at valuations of $6 billion and $12 billion on the stock market. So John had very high success in the past, and we hope that he can repeat that with Trevi System.
And I did notice, pre-money valuation, 120 million. They do have 2.1 million in revenues. If you do the math there, kind of expensive from a revenue multiple perspective. But what do we think in terms of the value and the valuation of this deal with potential returns for investors?
Yes, the valuation is definitely somehow high. 120 million means that in order for investors to get a 10x return or more, if I'm not even accounting for dilution, the company has to be at least a unicorn. So it has to at least exit at a 1 billion valuation or more. Well, what we've seen a lot of recent traction with the company. Just in 2024, Trevi already booked 15 million dollars worth of contracts. So that shows us that there is traction, that the company is moving to bigger project, is signing contracts with large actors, and could potentially generate enough revenue maybe next year already to justify this 120 million valuation. So we're taking kind of a more risky bet by investing into Trevi because we're investing at a very high valuation. But we have to remember the company has 65 patents that are protecting its technology. And its technology is one of the few that is able to make forward osmosis very low energy intensive. Actually, Trevi claims that it can desalinate water or clean water with zero carbon emissions. So that also justifies the valuation of the company because we can imagine that if the company were to go under for whatever reason, well, then these patents will still have value and could eventually be sold and bring a little bit of returns to investors.
Yeah, and I think when I first saw Trevi, it came across as like a borderline, like deep tech type of company, like a company that's really revolutionizing an existing technology, and that will likely require a lot of capital because I think it's a pretty capital intensive business, if I recall correctly. Like the negative net income per year is like multiple million, but if you're trying to develop and commercialize a technology that's really disruptive, especially in something like water desalination, just like a very physical thing, that can take quite a bit of capital. So the valuation wasn't all that surprising to be this high. I mean, we see this in med tech and pharma too. Like companies that require a lot of capital generally tend to have higher valuations. It's like, again, like a borderline moonshot, but they definitely have a lot of traction already. So it's kind of a de-risked moonshot. But generally with a company like this, like Leia was mentioning before, like team is just so important, not only for execution. If they have prior exits, like that's a great sign that they know how to grow a startup, but also shows that they know how to raise money, which is also very important in startups. Is a team has to be good at raising money, and I think Trevi's raised a couple million already, but having had previous experience growing startups, that's a great sign as well on the fundraising side. So super cool one. I think it's a great addition to the Kingscrowd portfolio.
Yeah, and down in the company funding and growth section, again, just with some of the new features, we show both the total prior capital raise. So this was from prior funding rounds, private, and then grants. And so they actually also have a lot of $13 million in non-dilutive grants. And that was one of the things that popped up. So especially if you have perhaps as Teddy was saying, he's almost looking at as kind of more of a deep tech company or something that's capital intensive, it could lead to more potential dilution for investors if there's going to be a lot more capital required to be able to get them to where they want to be. But being able to get some funding that's non-dilutive, so grants are considered non-dilutive because basically that's money that the company can use that isn't going to dilute existing shareholders. And it's always good to see companies being scrappy and getting funds through that way. Anything else before we move off of this?
Yes, you just said something that is very interesting. How much money is the company going to raise in the future, and how much are current investors going to be diluted? Well, I'm not saying the company is not going to raise, it still has to sustain its operations. But in terms of funding the projects, typically projects are not funded by equity, they're funded with specific project finance strategies. So that means that we could have specific equity and debt investors coming project that would finance the project, allow Trevi to operate the desalination plan and get its money back from its client, and they will share the revenues back with the debt and equity investors, and then the revenue will impact also Trevi Systems.
Awesome. Well, I think we will wrap things up there. Great discussion today. Thank you again to both Leia and Teddy for the engaging discussion. We will see everyone back here next week. Have a great Halloween.